Everything changes now because the latest gold forecast is nothing like what analysts predicted just a few months ago. For years, investors have speculated about gold's next major breakout, but very few expected the explosive scenario that is being discussed today. A growing number of economists claim that gold may be entering a historical repricing cycle, one that could push the metal toward the $3,000 level far faster than the market realizes. But before jumping to conclusions, we need to understand what triggered this sudden shift in sentiment. Why are banks and hedge funds updating their targets at the same time? Why is physical demand rising even as global uncertainty seems to normalize? And what data are experts seeing that ordinary investors cannot? Today, we break down the real forces behind the new $3,000 projection and uncover the hidden trends driving gold's most important moment of the decade. The signal no one expected came from an unusual place, long-term macro data that suddenly flipped direction. For over a year, inflation numbers appeared to cool, central banks hinted at stability, and global markets started pricing in a soft landing. But behind this calm surface, a deeper structural imbalance was forming. Governments accumulated record levels of debt, bond markets distorted, and currencies weakened faster than central banks could react. When analysts reviewed these numbers again, they discovered a pattern almost identical to the one that preceded gold's explosive rally in the early 2000s. That's why this new forecast matters. It's not based on emotion, but on repeating macro cycles. And when those cycles align, gold historically does just one thing. It surges. Why is $3,000 suddenly no longer impossible? The answer lies in the shifting relationship between real interest rates and gold demand. Typically, rising yields suppress gold prices, but we are entering a rare stage where yields rise while confidence in currency weakens. This disconnect creates a unique environment. Money flows into both bonds and gold at the same time. Additionally, structural shortages in the mining industry and a decline in global extraction rates are limiting supply. Central banks, especially in emerging economies, are buying gold at the fastest pace in modern history. When you combine restricted supply with accelerating demand, prices don't just grow, they can reprice violently. That's why $3,000 has moved from a theoretical target to a realistic path. The real driver behind the $3,000 projection is something analysts call silent accumulation. While retail investors wait for headlines, institutional players make moves quietly, without drawing attention. Over the last 6 months, several nations increased their gold reserves without public announcements. Major banks adjusted their internal models, predicting sustained upward momentum. These actions create a delayed shock effect. By the time the public notices, the price has already moved. Silent accumulation explains why gold sometimes rallies without warning. It reflects decisions made months earlier. And according to available data, silent accumulation is happening right now at a scale not seen since the 1970s. The weak spot in the dollar is becoming increasingly visible, and gold reacts directly to it. The dollar's strength is based on global trust and the stability of U.S. debt markets. But with rising deficits, political uncertainty, and foreign countries diversifying away from the dollar, cracks are starting to form. Analysts aren't predicting a collapse, but they are warning of a long-term decline in purchasing power. When the world senses that the dominant currency is losing its grip, gold becomes the natural hedge. Every historical cycle shows the same pattern. Weakening dollar equals strengthening gold. And if the current trajectory continues, the path toward $3,000 becomes even clearer. So why did analysts change their forecasts now? Because the standard models stopped working. Traditional economic tools predicted stability, yet the market showed increased volatility. Geopolitical tensions, supply chain disruptions, and rapid monetary policy shifts created an environment where old formulas could not explain new behaviors. As a result, analysts updated their risk frameworks, giving higher probability to a sharp gold revaluation. These updates weren't sudden guesses, they were responses to data that could no longer be ignored. And when multiple independent institutions reach the same conclusion, it signals a deeper truth rather than a temporary trend. One of the most underrated factors behind the $3,000 projection is the long-term decline in mining output. Gold mining projects are becoming harder, deeper, and more expensive. Many high-quality deposits have already been exhausted, and new exploration sites are far less productive. Supply is tightening at a moment when global demand is rising sharply. This mismatch has no quick solution. New mines can take 10 to 15 years to become operational. That means the supply shortage is not temporary, it is structural. And structural shortages always push prices higher. Right now, precious metals are entering what experts call a perfect storm: economic uncertainty, rising global conflict, higher debt levels, central bank accumulation, and slowing mining production. Any one of these factors could increase gold prices on its own, but all of them happening at the same time creates extraordinary upward pressure. Markets rarely experience such synchronized forces. That's why many analysts believe we are not just witnessing a rally. We are entering a long-term supercycle where gold could outperform most major asset classes. The perfect storm is already forming, and the market is starting to feel the first winds. If gold crosses $2,500, a psychological barrier will be broken. Historically, once gold breaks a major resistance level, momentum accelerates as more investors rush in. Technical traders follow signals, retail investors panic buy, and institutions increase allocations. This creates what analysts call a feedback loop. Price increases attract more buyers, which pushes prices even higher. If gold reaches $2,500, the next major target becomes $2,750. And after that, the $3,000 mark becomes a natural extension. In markets, psychology is as powerful as any economic indicator. There is a hidden risk that almost no one is talking about: the global liquidity gap. As governments continue increasing debt, the financial system relies on constant liquidity injections. If liquidity tightens while debt expands, markets become vulnerable to sudden corrections. During such periods, gold historically becomes the safest alternative store of value. Investors shift from risk assets to hard assets, and gold benefits directly. This hidden risk may be the final catalyst that pushes gold into a new price era. Many analysts believe $3,000 could arrive faster than the market anticipates because of compounding catalysts. Every economic event, rate cuts, geopolitical tensions, currency weakness, adds a layer of pressure. When these layers stack together, the price does not rise gradually, it jumps. Gold has a long history of sudden repricing moments. These are periods when the market collectively realizes that the old price no longer reflects reality. And according to the latest forecasts, we may be approaching one of those moments right now. What investors should watch next is the behavior of central banks, bond yields, and global demand for physical gold. If central bank buying continues at its current pace, and if real yields stay volatile, gold will have a solid foundation for a multi-year rally. The key question is not just whether gold will reach $3,000, but what will happen after it does. Because if the global economy continues following the current trajectory, $3,000 may only be the beginning of a much larger upward cycle. The next few months will reveal whether this forecast transforms into reality.